For years, cost control and growth were treated as opposites. If a company was cutting costs, it usually meant demand was slowing or margins were under pressure. If a company was investing heavily in growth, expenses were expected to rise. Expansion meant hiring, marketing, infrastructure, and capital spending. Efficiency was often viewed as defensive. Growth was viewed as offensive. But in 2026, that thinking has changed. Cost control is no longer just about protection. It has become a growth strategy. This shift reflects a deeper transformation in how businesses compete. In a world defined by tighter capital, volatile demand, and higher investor scrutiny, sustainable growth depends less on how much you spend and more on how intelligently you operate. The first reason cost control now fuels growth is capital efficiency. When companies manage costs carefully, they generate stronger free cash flow. That cash flow can be reinvested into innovation, product development, marketing, acquisitions, or strategic partnerships. Instead of relying on external financing, companies fund expansion internally. Growth financed by efficiency is more resilient than growth financed by debt or equity issuance. It reduces exposure to market swings and protects long-term strategic control. Interest rate dynamics reinforce this logic. In a higher-rate environment, borrowing to fund expansion is more expensive. Capital markets are less forgiving of aggressive spending without visible returns. Companies that control operating expenses create room to invest without increasing financial risk. Cost discipline becomes a source of strategic independence. Technology provides a clear example. In previous expansion cycles, many tech companies prioritized scale over efficiency. Headcount grew rapidly. Infrastructure expanded ahead of demand. Marketing budgets surged. When market conditions shifted, margins compressed, and large restructuring programs followed. Now, leadership teams are embedding cost discipline into long-term strategy. They are using automation, AI-driven workflow optimization, and streamlined management structures to increase productivity per employee. When productivity rises without proportional cost increases, operating leverage improves. That leverage supports profitable growth. But this shift goes deeper than payroll or infrastructure. Companies are redesigning internal processes to remove friction. Procurement systems are being digitized. Vendor contracts are renegotiated with performance metrics attached. Data visibility across departments is improving decision-making speed. Every efficiency gain compounds over time. Why cost control is now a growth strategy also connects to pricing flexibility. Companies with lean cost structures can respond to competitive pressure more effectively. They can adjust pricing without destroying margins. They can enter new markets with lower break-even thresholds. They can experiment with new business models without overwhelming financial exposure. Lower cost bases create optionality. In competitive industries, optionality is power. A company that can absorb temporary margin compression to gain share is positioned differently than one operating at thin, fragile margins. Another driver is demand uncertainty. In volatile markets, aggressive spending can become a liability if revenue slows unexpectedly. Companies that maintain disciplined expense control preserve stability during downturns and are positioned to accelerate when demand recovers. Cost control provides the foundation for consistent execution. It allows management teams to make strategic decisions without panic. There is also a structural shift toward recurring revenue models. Subscription-based businesses depend on long-term customer retention. Managing customer acquisition cost, service delivery expense, and churn rates directly influences growth sustainability. Efficient cost management allows recurring revenue to translate into predictable margin expansion. Growth is not just about adding customers. It is about adding customers profitably and retaining them efficiently. Operational efficiency also strengthens competitive positioning. Supply chain optimization reduces delays and waste. Digital tools improve inventory management. Data analytics enhance forecasting accuracy. Each of these improvements lowers operating friction and frees resources for expansion. In manufacturing, predictive maintenance reduces downtime and unexpected repair costs. That increases output without expanding capacity. In retail, inventory optimization reduces working capital strain while improving product availability. In logistics, route optimization lowers fuel costs while improving delivery speed. These efficiencies drive revenue growth without heavy additional investment. Investors are reinforcing this trend. Markets are rewarding companies that demonstrate disciplined margin management alongside revenue expansion. Growth at any cost is no longer celebrated in the same way it once was. Profitable growth carries greater credibility and stronger valuation support. Companies that can show revenue growth paired with expanding operating margins signal structural strength. There is also a cultural transformation inside organizations. When cost control becomes strategic rather than reactive, teams become more accountable. Spending decisions are tied directly to measurable outcomes. Departments collaborate more closely to eliminate duplication. Leaders focus on value creation rather than budget expansion. This creates a performance-oriented culture. Why cost control is now a growth strategy ultimately comes down to sustainability. Rapid expansion fueled by unchecked spending can produce impressive short-term results. But if margins deteriorate and capital reserves weaken, that growth becomes fragile. Disciplined cost management strengthens the foundation. It enhances free cash flow. It reduces volatility. It increases resilience. It supports strategic flexibility. It enables companies to pursue long-term opportunities without compromising balance sheet health. This does not mean cutting costs indiscriminately. Strategic cost control is different from reactive cost cutting. It focuses on eliminating inefficiencies while protecting core capabilities. It prioritizes automation over layoffs, optimization over austerity, and process improvement over contraction. The goal is not to shrink, it is to strengthen. In a business environment shaped by uncertainty, technological acceleration, and investor scrutiny, companies that master cost control gain a structural advantage. They can invest with confidence. They can scale without overextending. They can weather downturns without panic. They can seize opportunities when competitors are constrained. Growth and efficiency are no longer opposites. They are increasingly intertwined. And in 2026, the companies that understand this shift, that treat cost control not as a defensive tactic but as a strategic engine, are positioning themselves for durable, profitable expansion that lasts beyond the next cycle.